Good day, traders. I trust you are well. My name is Nyabadza. Welcome to price action trading, the open of the Asian market sessions. Now, you are watching this video as a core part of the month-on-month subscription to this very show, price action trading, the open of the Asian market sessions. This video is a recording of the core of our strategies, which I unpack based on real market action on a week-by-week basis. So I look forward to your questions and answers in the chat box as you watch the videos presented to you by Actions to Wealth. So just speaking from personal experience, at the open of the day, the open of the Asian market session, that's the open of the trading day, what we are primarily trading is energy. We have never had anyone say this, but we are trading energy, pent-up energy from overnight or newly generated energy for the day. The trader's equation, which is relevant throughout the day, is more pronounced at the open because of how the energy dynamics impacts its missing link. And guess what is the missing link? You are the missing link in the trader's equation because only you can make you a success at trade. Now, I speak from personal experience. When that first candle opens, be rest assured the market will throw absolutely everything and all things at you. In any combination reflecting the present energy in the market, your task is to go with the strongest energy flow that reflects your strategies, the strategies that we are going through here. Now, remember that some days, none of the manifesting energy reflects your strategies. So be at peace, be tranquil, let go of the day, and come back tomorrow. And start all over again with the same energy and commitment to search again until your strategies manifest. And when they do, trade decisively, manage precisely, make the decisions in the moment, and allow yourself time to reflect at the end of the day or of the week in terms of what you've done against these strategies. If you allow yourself to be seduced by everything manifesting in front of you, especially at the open, be assured that at some point you will crash and burn. And because you are a trader, just like I am, you will never give up. So you'll have to go through the tough process of rebuilding your confidence again until you master the missing link in the equation. And you are the missing link in the trader's equation, because only you can make you a success at trading. So build wealth wisely. Now, what is the trader's equation in terms of it at the open? So the trader's equation is the trader's equation. It applies throughout the whole day. It is made up of three components that every trader should know: risk, reward, and probability. But I have added a fourth, the missing link, just based on my own experience. We can learn everything we can about the technical side of trading, risk, reward, and probability, but no one can teach you how to master your own psychology. Well, a coach can point you in the right direction, but ultimately, you have to do the work that is required to master you. Risk is a factor of your capital allocation decisions that you make. Reward is a factor of your capital management decisions. Probability is a factor of your consistent application of your strategies over a basket of trades. We can debate what a basket of trades is, but, look at 20 trades if you trade in a higher time frame chart. If you trade in a lower time frame chart where you take a lot more trades, look at 100 trades. So probability is a factor of your consistent application of your strategies, and the market's issuing you a random distribution of trades. That is very important to bear in mind. Everything we're going to be talking about is about increasing our probabilities or making sure we have the probabilities in our favor, which means whatever the market throws at us, we want to make sure that we have favorable probabilities to work with. Remember, the missing link, the psychology, is you. This is the zone where you find your inner peace and tranquility. If you violate this zone and allow disturbance to come in and do not quickly resolve it, trust me, you will crash and burn. And then you'll have to go through the whole process again of starting as if you're a beginner to rebuild your neural construct. So master the strategies, master yourself. Strategies are either high risk, high reward, or low risk, low reward, or somewhere along the risk reward continuum and what you trade. Ultimately, depends on the missing link, you, the psychology, and where you find tranquility and peace. So this is very important. The trader's equation, risk, reward, and probability plus psychology. Your psychology lets you determine the strategy that makes you trade. You know, I can show you everything, but you're going to have to make a decision as the markets unfold before you. How much to risk per trade? You make the decision. This is important, whether you enjoy this business of trading or not. The moment you start to regret being in this business, you're just going to compound the problems of psychology and you just spiral downwards. How many markets do you have on your watch list? That again depends on you, your energy, your focus, the way you manage yourself. There's things that we're going to discuss continually in weekly videos: where to place your stops, how to manage your stops, where to take your profits, how to optimize your profits. These are going to be discussed in the weekly videos based on what's actually happening in the market on, in the 4 markets that we're going to be focusing on. Which market conditions based on our strategies to step away from? Again, we discussed in the video, say, guys, this is what's taking place. This is not part of our strategy. So just walk away, just let it be. So with that, what did I mean by high risk, high reward? Breakouts and reversal strategies are high risk and high reward. What I mean is you get stopped out more often. But when they run, you get very high reward. Typically, and this is just like an average, 40-60 win ratio out of basket of 100 trades, you're going to win 40 and lose 60. But wins are the greatest. Now, these strategies require mental and emotional comfort with losing streaks and no deviation from strategies when losing. But if you want something more evenly balanced, medium risk, medium reward, you can't have both. Low risk and high reward. The market does not work like that. You want to take a breakout and reversal strategies before things become pretty clear. That's higher risk, but you get higher reward. Okay, you want something that's medium risk, wait for trading ranges. And if you trade them perfectly, 50-50 out of basket of 100 trades, you win 50, lose 50. But your wins are pretty low. Your wins are the lowest in terms of the yield per trade, the percentage you make per trade. These strategies require comfort with scalping. That means you're going for very low rewards, half to 1, maybe 1-to-1. If we are talking of swing trading, you're aiming for at least 2-to-1 for every trade. You may not get there, but your mentality is to find 2-to-1 trades. Got to be comfortable with scalping and taking them out multiple trades as when you develop. You can't get tired doing this. Otherwise, your basket of trades doesn't work. Then, if you want something that's lower risk, but it's also low reward because you can't get both, you get stopped out least often of all of these, then just work on trends. Out of a basket of 100, you should win 60%. Wins are medium. They require comfort with waiting patiently for trends to develop and then executing a strategy, even if it's just once a day on lower timeframes or once a week or fortnightly on higher timeframes. So do spend some time on this. Think about it. Think about who you are, your psychology, and works out well for you. If you do not know, do not worry. The market will quickly educate you on what gives you the best, what puts you in the best zone, inner peace and tranquility. So there are 4 strategies, trade in the open, that we are looking at. I just break them up as first, second, or third candle breakout trades. First, second, or third candle breakout trades. So when the market opens, either we're going to trade the first candle, the second, or the third candle. If we don't do that, well, after a pullback, if there is a strong breakout, we wait for trend resumption and you want to trade back into the trend that is now evident after a strong breakout. As soon as there's a first pullback, you want to get back in and trade. Then we want to look for trades from two push reversal patterns. I deliberately call these 2 push reversal patterns and the 4th one 3 push reversal patterns, because the market will throw things at you that do not look like perfect double tops, double bottoms, wedges, etc. that is how the market works. And I want us to get into the experience of the market. So it is best for us right up front to think of them as 2 push reversal patterns, whichever way the market throws them at us, or 3 push reversal patterns. So we're going to work through 4 distinct strategies. Okay, these are the strategies that we're going to use on trading the open of the Asian market sessions. So it's deliberately trading the open of the Asian market sessions. There are 3 broad market sessions. You may or may not be aware of this. There's the Asian session, which of course includes other exchanges in that time zone region: New Zealand, Australia, Japan, Hong Kong, Singapore. That's all part of the Asian session, and anything else in that time zone region. If you look at the map, there's the London session or the European session, which includes UK, France, Germany, and other exchanges in that time zone region. There is also the US session, the 3rd session, which includes New York and other exchanges in the time zone region. Now, these sessions break up the 24-hour day that we trade. You know, when the markets open, they're starting from the land where the sun rises to where the land where the sun sets. So that's what you got to bear in mind, these 3 broad market sessions. Now, what is the open of a session? George, when you say you're going to trade the open of a session, what is basically accepted as the open of a session in terms of price action trading? And generally, I think most traders trading on lower time frames will agree with this sentiment. Number one, first candle of a specific session, well, it's pretty easy when the key exchange opens. So if you're looking at an index, when the key exchange, the exchange for that index opens, that is the open. That's the first candle of the specific session. And then from there, we're talking of the next 18 to 24 candles. Okay, so the first 1.5 to 2 hours of each session. Now, so what is the open of the Asian markets? Well, I just consider the key exchange in that region. That's what you're going to consider. Now, if you trade in out of New Zealand and that's your trading zone, then you got to look at that exchange, right? Australia, you got to look at the exchange, you know, and you keep shifting yourself west. So I use Tokyo Stock Exchange as the key opening exchange for the region, purely because of volumes. You know, it's the highest volume market of the region. So that's what I use as a marker for the open of the Asian markets. Now, markets are 24/7. Okay, so you will find all the markets, you know, as we just tick over GMT midnight, there will be price feeds going through. So you need to be pretty clear where your open is. So for the purposes of this particular program course subscription that you own, you're going to use Tokyo as the marker for the open of the Asian session. Now we trade in Nikkei 225. You also trade in Hang Seng 50. So we've got to know when the Hang Seng 50 officially starts to trade, and that is 9:30 a.m. Hong Kong. That is the time that you are trading you know. So you've got to consider, you've got to mark that down specifically, because if you don't have that, you know, you're going to be sitting there, and I've had the experiences, and, you know, you're sitting there and the market is moving and you kind of wondering and say, oh my goodness, so where exactly are we, or what is happening? You're going to have a problem. When Tokyo opens 9 a.m. In Japan, you know, I can use GMT 2 p.m., 2 a.m. GMT as a marker, and you can work it out for your own sessions. That is the open, the main open of the sessions. Then any other index you trade, just find out when the exchange opens. So first candle, when the exchange opens, and then the open is defined at the first 1.5 to 2 hours. Thereafter, the market has high probability of transitioning from what it has been doing since the open. So there is generally a distinction between how the market functions in the first 1.5 to 2 hours, the open, and how the energy changes and it transitions to be doing something else after the open, and then it will transition to do something else more towards the close, and we'll talk about that just now. What is important is we transition to different strategies when market behavior changes. So these strategies that we get to trade are all covered in depth in my best price action strategies course. So there are other strategies that we trade when market behavior changes past the open. Those are covered in detail in my best price action strategy course. Contact the AUDJPY office for more information in terms of how to get onto that. There are 3 broad periods in a day of trading in any particular market, any particular session. Remember, nothing is cast in concrete, but generally the market is divided itself into the following 3 broad categories. The open, the first 1.5 to 2 hours, and then the market generally transitions to a different type of behavior in the middle. These are the 3 to 4 hours in between of a particular session. Most sessions are running from 7 hours to 7.5 hours to 8 or 9 hours. So, that kind of range for a particular day session in a particular market. Then we have the end of the day, which is the last 1.5 to 2 hours. Now, remember, there's also overlaps in terms of markets. I mean, the Asian market opens first, but if you think about it, when you come to the end of day for the Asian markets, you are getting into the open of the day for London session European markets. And when you get to the end of the day for the London European markets, you're overlapping with the open of the US market. So in overlaps, there's big volumes, big dynamics, big fun things happening. Now, these 3 broad categories prepare us to transition to different strategies when market conditions are changing in front of us. So there are, I'm trading up to 5-minute charts, and that's the examples that I'll be showing you. However, we need to bear in mind that markets are fractal, that beautiful word, Fractal, which it simply means whatever chart patterns you see on one time frame, they will repeat themselves on another time frame. So it doesn't matter whether I use 5 minutes charts or 1 hour or whatever the case may be, the price action patterns are the same. Now, if you're trading lower time frame charts, it is absolutely important to realize that important price action things happen around key levels of support and resistance. So you need to do a bit of work in preparing your charts, and you save them in profile. So hopefully, when you switch on and off, your lines are not deleted. But if you switch to the monthly chart, all you want to mark is all-time high, all-time low, high of last year, low of last year, and any other distinct and visible level of support and resistance that you see. Whether it's a breakout or a trading range, you need to mark that. Hidden levels of support and resistance, I will talk to you about as we go along. They exist, but there is ways for us to mark them on our charts. Then you need to switch over to your daily chart, and whatever you see as a high of last month, just mark that with a horizontal line, low of last month. If there's any distinct bull breakout levels, bear breakout levels, any other level that you see that say, hey, that's pretty distinct, the market has been going sideways here or did X, Y, Z, that I can see, mark that level. Because if you can see it, rest assured computers will see it. Computers also see these hidden levels of support and resistance, and we will talk about that as we go along. The reason you mark them and just leave them on your chart is that when these levels appear while you're trading, you can quickly just highlight and see if you made a note on them. If you do not make any note on them, just go to a higher time frame and see what is coming into view, so that when markets react there, you are not shocked or surprised. Then, as we drill down to the chart that we are trading, the 5-minute chart, at the beginning of every day, I make sure I mark high of yesterday. I just use a lime green color. And low of yesterday, I use a red line. Then any key levels of support and resistance I can see from the previous session. I don't want too many lines on my chart. Okay, so if I see anything that's significant, I mark it. If not, I just leave it. As long as I have the high of the day and the low of yesterday, that is sufficient. Then, as the day is unfolding, as the 5-minute chart is unfolding, I want to mark the open of today. Now we're talking about the open of a particular session. That open I want to mark. Then any measured moves of the first, second, or third candle. Now, measured moves are hidden levels of support and resistance. And again, I will show you how that works. Any measured moves of any trading range at the open. So again, these are the 4 strategies. We're going to go into them. Now, this is a quick and punchy presentation, guys. Remember, you can always come back to it. But I think the most important thing is for you to delve in the weekly videos as they are released so you can see how things have actually unfolded. And then you start to rewire your brain, basically, to recognize things. For the sake of time and brevity, I'm only giving about 1 or 2 examples at max per each particular one. Now, first, second, or third candle breakout trades, bulls. Look at this. We're talking about Hang Seng 50. When you see a first candle like that, bull breakout, no hesitation, you have to jump in and take the trade. The bulls are in control from the first candle, and each trend candle that closes extends the measured move. So bulls close there, you take that trade, or you take the second candle, or you take the third trade. You know, you might be slow to respond or react. You don't take all of them. You need to take one because you need some clearance from your entry before you take additional trades. And that's part of trade management, which we'll cover in the weekly videos. Now, what do I mean by measured move? If you look at this breakout, first 3 candles, there is a low of the first candle. There is the high of the third candle. The bulls, if they are strong, they want to make sure they get to the same height as these 3 candles. So that's the measured move up there, measured move of the third candle. Obviously, if you think about it, when you're taking this trade, you're saying, okay, the measured move of this trade is just the height of this trade. So it's about here. At least there is a high probability that the market will get there if the bulls are strong before it pulls back. So at least you can get to 1-to-1. And as the breakout continues, you keep increasing the measured move target, which gives you assurance that there's a higher probability that the market will continue to go in your direction. Ultimately, this particular trade, if we did nothing else, the market go to the measured move of the first, second, and third candles right there. That's why there's a bit of a pullback and you'd have had to exit. But if you'd taken any of these trades, at the very least, you'd have been rewarded by 1-to-1. So that's an example of first, second, or third candle breakout trade. Now, let me just focus on this. We're looking for breakout candles. A breakout is a trend candle in terms of bulls with no tail at the top or a very small tail at the top. Like that's a small tail. Moment you have a tail that starts to extend a quarter, a third to a half, that is no longer a breakout candle. It is still a trend candle because controlled by the bulls, but we don't want to buy above candles that are already showing weakness. So we want to buy above candles closing on their high with little or no tails. So you look for that first, second, or third candle trades as far as bulls are concerned. Another example, first candle trade. Okay, Hang Seng 50, 930, when that open. Your broker might be feeding prices. Ignore all of those until you get the first candle. First candle, you take that and you say, I think there's a high probability that the bulls will get to a measured move, which they did before there is a pullback. Now, this tool that we use here is a Fibonacci retracement tool. And the only markers you want on it is the 0, 50, 100, and the 200. And because we're going long, you put the tool here and you pull it to the bottom. And I'll show you many examples as we go through the weekly videos. But there is a measured move, so you can confidently take that trade. That's got a tail on top, you don't want to take that. That's got a big tail on top, you don't want to take that. That's the only trade in this particular example. Go to the measured move, and then you get out of the trade. First, second, or third candle breakout trade. First candle, small tail, you can take that second candle, small tail, virtually nothing. You can take a third candle, no tail. So first, second, third, you could take any of these, and there is measured move. There is a height of the third candle to the beginning of the first candle. There is the measured move. The market didn't quite get there, but you will learn to recognize these three push patterns as reversal patterns, and you have to get out. Once you see a reversal pattern, which we'll talk about, as part of our strategies to identify trades to trade, when that is set up, you realize, okay, we're not going to get there. I can bank my profits and I will exit. First, second, or third candle breakout trades. Breakout trades for bears. First candle, high test, closing on its low. You take the trade, there is a measured move. If you take that trade, there is a measured move 1-to-1. Now I'm saying 1-to-1 if you use a tight stop above here. Now you have options with stops. Either put a stop right here, or you can use a measured move stop. As soon as the market starts moving in a direction, you remove out the risk. So as a trader, you always have to decide on your appetite. Do I use a tight stop, or do I use a measured move stop, which lowers my risk? Depends. If you use a tight stop, of course, you make 1-to-1. If you use a measured move stop, you make half the risk. It's just a matter of preference. But there is a measured move. When you see that kind of candle, high test candle is another example of the candle that we trade. Remember, other examples you saw were full candles, whole candles, a full bear candle. But in this case, the market opened here, bulls tried to control it, failed, came back to the open, closed here. It's a high test candle, it's a trend candle, no tail at the bottom. Trade that we must take. Here's another example. Interesting candle, isn't it? At the open, big bull candle. If you had blinked, said, the bulls are in control, let me get ready to buy. It can change suddenly like that and give you that kind of candle. Big tail, it's a dodgy candle, but we're going to take that candle because the bulls failed to break out on the first. On the first candle, there is a measured move. The market got to that measured move. There was a deep pullback. Why was there a deep pullback? Because this kind of candle is a dodgy candle. We took it. Measured move. A doji is a trading range, measured move of the trading range. So you have an option. So I know it's a doji trading range, taking a breakout trade, high probability that there is still room to get to 1-to-1, but it can also fail. Okay, so it fails initially, you hold on to your trade, and it gets to the measured move. It fails initially, you decide, oops, I'm going to get out pretty quickly. You get out of your trades. That's perfectly fine. By the way, the EMAs I've got, in this example, I've got the 10 EMA, which I use to mark the strongest part of a trend. It's just, instead of drawing trend lines, I just use a 10 EMA. Or you can use a 20 EMA, which is pretty common for 5-minute price action traders to use. Here is another example using a currency, in this case, Aussie yen. Okay, there was the first candle. Now, why is that the first candle? Because this is taking place, like I said in my intro, at the open of Tokyo Stock Exchange. That's the marker that I use. Trading the yen, that is the marker that we're going to use. There is the first trend candle. It's a currency. The market has already been moving. Unlike an index, market has already been moving. So, I want confirmation that the bears are strong. It must close beneath these earlier levels. Opening of the breakout. Wait for the second candle trade, sell beneath it, disappointed, of course, with a small follow through. But there is a measured move. And I'm thinking, if the bears are strong, there's a high probability that we'll get to the measured move. Now, the thing to bear in mind, and you might have picked it up when we were talking about indexes, I just completely ignore everything to the left because that index is open there. Pre-market plays a bit part, which is fantastic. But as far as indexes are concerned, we only concerned with the open. As far as currencies are concerned, we're saying to ourselves, well, there's the open of this key exchange, Tokyo. But you are aware, that there's already been movement. Aussie could have announced something's taken place. So there are key levels in the market. So that's the low of the day so far. Let's just get a close beneath it before we execute our trade. We were rewarded by taking that trade to get to a one-to-one. Again, same thing for stops, use a tight stop or look to the left currencies and say, okay, I'm going to put my stop above here. Of course, with a wider stop, you get less stopped, you get stopped out less often. When you get to this one-to-one for the breakout, you are slightly less than one-to-one, but it's a correct stop to use. So you're going to have to decide which stops are suitable for your personality. Another currency, New Zealand yen. Now look at this. Unlike the earlier currency, the one that we just seen, New Zealand yen, the first candle that we're looking at in terms of the Tokyo Stock Exchange is closed beneath the prior low. So that's the first candle trade. You can take that first candle trade, put a stop here, or use a stop above the high of the day, or even a measured move stop. You know, if you're more comfortable with that. Measured move stops are perfectly fine. Tight stops are perfectly fine. Random stops within here are not fine because you can just get stopped out unnecessarily. The other thing that I use when trading currencies I always want to make sure I have the minimum stop of 15 pips. That's what I use as a measure. Very rarely do I go tighter than that. I might go to 12 pips, you know, depending on the structure of it. But 15 pips is general guideline for stops. So if this was like 7 pips, I'm going to go find 15 pips and put my stuff because of spreads and all of those things that take place. For indexes, I just use exactly what I see in terms of where I put my stop, tight stop or measured move. So you could take a first candle trade here if you wanted, or you could say, I'm going to wait for follow through and take a second candle trade. Wait for follow through. Sometimes you may not get the market might just accelerate down. Look at this first candle trade, one-to-one was here. So there was no need to get off the trade. You ended up getting rewarded, you know, by a much bigger move because of that breakout candle. So if it held on to it past the one-to-one of the first candle trade, you would have been able to get out much later on as the market hits the measured move of the breakout. So first, second, third candle trades. Now, let's have a look at the next strategy that we trade. So the other thing we look at, if you are already in first, second, or third breakout trend candles, or if you are not, if you see a strong breakout, in this case, a strong bull breakout, then wait for a pullback. If you're already in a trade and the price has moved far away enough from your entry to put your stop near break even, then you're going to look to scale in, right? If you're not in break even, do nothing. If you have missed the entry and you see a strong breakout, in this case, talking about bulls, wait for that first pullback. Then we want to get into the market as that strong bull breakout resumes. And we call that breakout pullback high one, breakout pullback high one, breakout pullback high one. The first time after a strong breakout and a pullback, the bulls look to resume. That's a breakout pullback high one. The first time they start to take out highs. Now, strong breakout, if you missed getting in 1, 2, 3, there's an opportunity for you to get into the market. And again, you got options. Either put your stop here, which I do not recommend for breakout pullback high ones. For pullback trades, I recommend you put a measured move stop here because the market might go sideways, you know, maybe double test that, maybe go a little bit below and stop you out and then accelerate up. That can be quite frustrating. So every time you do a breakout pullback high trade, high one or low one, if we go in short, use a measured move stop at height, measured move stop. That's where you put your stop. As soon as the market starts to accelerate, of course, then you can tighten. So trend resumption after first pullback is what you call breakout pullback high one. It is that clear and that straightforward. Here's another one, first, second, third candle, 1 bar pullback, trend resumes. If you are not in any of these, or if you took that first one and your stop is now a break even and you want to scale in, you do that, measure move stop, high one there, you jump into the trade. Strong breakout, it has to be a strong breakout. If the breakout is weak, do not do anything. Currency, New Zealand yen, breakout above the trading range. good enough breakout, strong breakout. So, if you took the breakout trade here or there, if you didn't, there is a breakout pullback, I1. We're not going to take that because the pullback has started, but there is a trade you can take, low test candle. You can take that, measured move stop down here. Or there's another breakout, pullback. There is another entry. Use a measured move stop of this whole structure. So stop is somewhere down here and you get into the trade. If you miss all of that, there's still another breakout. You can see the strong breakout, small tails on the top. Pullback begins I1. You can take using that structure, measured move here. When the entry is almost the same as a pullback, just use the measured move stop of that. When it's a small candle, I look at the measured move of that whole structure and put my stop here. But there's a strong trend, there's a pullback, and I'm getting into the resumption of the trade. Same thing for a bear breakout. There's a strong bear breakout. I want to wait for a first pullback, and then when the trend starts to resume, I want to jump into the market. Bear breakout, small tails are breaking out. Bear breakout, there is a pullback. It's a doji, but it's a pullback. You can take that trade. If you've seen that, I use a measured move stop. So the stop is probably still somewhere up here. If you use a measured move stop, if you put a stop here, understand you'll get stopped out more often and you're going to lose a lot of money. If you're comfortable with getting stopped out more often, hoping to make more money, by all means do that. I don't do that. I use a wide stop. So the stop is going to be somewhere up here. Breakout, pullback, low one. There's another breakout, pullback. That one didn't get triggered because I want to wait for it to break significantly below level. Breakout, pullback. There we go. We got triggered on this candle that is here. You could have put an order here if you're fast enough. I don't know, maybe it could have been triggered within the Bahrain market. But then same thing, look at the measured move. So stop is still above here. No tight stops in this particular case. Another pretty clean one, breakout, pullback, but look at the entry is down here, and that's where the entry is. Put the entry here. Now, when you have an entry that's gone below a previous low, you can use a tighter stop. You don't have to do a measured move of this whole thing. You can move a stop here, which is almost roughly the measured move of just that candle. Just want to avoid using tight candles, tight stops. Then we have a breakout, pullback, low one, another one. Here, same level, measured move, so stop is somewhere above here. So all of these are trend resumption after the first pullback in a strong bear breakout. That's a breakout, pullback, low one entry that you want to take. Now, what of two push reversal patterns? What of two push reversal patterns? Let's go into that. Two push reversal patterns, basically, the market has tried to do something twice. Two pushes down. The market tried to go down. Once it failed. Tried to go down again, it failed. The market is just down, tried to do something twice. Two pushes down. Failed, get a bull breakout. That's a trade that we take. And your stop, if you do a measured move stop of that, is way down here. Okay, two pushes down by bears. Large tails means bulls are buying. Bulls are buying. Okay, something else about this. Bear breakout. Failed breakout, FBO, failed breakout below first candle measured move. There is the first candle. It's a doji. Tails on top, tails below, so you don't sell that. There is a measured move of it. Bears did get there. It's a trading range. We go to that measured move. The bears were strong. They would have continued to sell beneath here and given us opportunities, maybe a breakout, pullback, low one. But failed breakout beneath it, first push down, failed tails below, bulls buying, and there's the opportunity to buy. And then the bulls reached the target. The target was the first candle. So you get a measured move of the first candle down here. But when it fails, the same first candle, still at the open, measured move is here, and the bulls got to their target, and then the market ultimately reversed. So we're looking for a two-push reversal pattern. If you use traditional terms like double bottom, where is a double bottom? Very hard to see. But if you look at two push reversal patterns and train yourself to think of the market trying to do something twice, and you can start to see the failures, then you see a trend candle, then you're going to buy. Bull breakout for another two push reversal pattern. Look at this. Bulls first push up, bulls went up, and they failed. And then the bulls tried again. There's the second push up. So bulls have tried twice. As the bulls have tried twice and failed, the bears pushed them down once. Here, this is a continuation of the bears pushing down once, which became a failed breakout, by the bears. And then the bulls created a higher low from all of this earlier price action currency. Earlier price action bulls created a higher low, micro double bottom. It's just a two bars between. So a big double bottom. It's a micro double bottom. So all part of the first push down. And then the bulls have a second push up. Failed by the bears, second push down. First push down by the bears, second push down by the bears. And then we have a high low and a breakout. So beautiful two push pattern. And you got to see it both ways. Bulls trying once, bulls trying twice, succeeding. Bears failing once, bears failing again, and then succeeding. Then you have the breakout, you buy the breakout. How about a bear breakout from a two push reversal pattern? So here we are, Hang Seng 50, once again. Bear breakout after two push patterns, a bear breakout after a trading range open. So there we have the first candle, tails on top, tails below. So not a good candle to buy, so do not buy. Wait for more information. It is the bull's first push-up, and the bull's first push-up has weak follow-through. So the bulls follow through, but it fell. It's still part of the bull's first push-up. Selling is by the bears. So the bull's first push-up has failed. We then get a lower high. And where is the lower high coming from? The lower high is coming from the bulls trying again the second push-up. And it fails dramatically with a strong reversal pattern by the bears. Now, so the bears have created this reversal pattern, but they haven't even closed beneath the first candle. The bulls try again. Now we are in a trading range. Bear breakout from two push reversal pattern. There's one, there's two. Or you could say the bears tried once, twice. It's a bear breakout from this pattern here. Bulls up, 1, 2. Bears down, 1, 2. But we are still within a trading range. So BTW, best to wait because we are still within a trading range. Let's see if the bears can follow through. We have a breakout, pullback, low one, fantastic. It's a failed bull's third push-up, but we are still within the trading range. So let's wait for more information because we might just carry on going sideways. Let's see how strong the bears are, if it is possible for them to break out, which they did below the trading range. But tails below, nothing for us to do. After the breakout, after the bear breakout, you see the measured move of the first candle. Bears couldn't even get down there because the bulls came back into the market to make the breakout fail. So the bulls came in to make the breakout fail. So bulls first push after the bear breakout. Bulls had an opportunity to just put a few more candles or, test these levels and then maybe go up higher. But they failed. We went into another trading range. Something interesting in the trading range. Market went up once and failed. Went up again and failed. So the bulls, they had this first push, failed. They had another second push. You could call this, part of the first push or another second push. But it's a lower high that we ended up in because of the bears making the bulls fail. So bulls second push in a tight range, TTR tight trend range, failed to get up to break out above that level. So bears are strong. Now, we have a decent enough lower high, decent enough follow through. You can sell this level. A little bit more complex, but it is a breakout. It's a complex pullback. And then you have a bear breakout beneath. So that is a fantastic trade to take. And we'll talk more about this as we see more and more of them coming in. But remember, you not just open your chart and say, hey, I'm going to sell, because you can't. You won't understand this. But if you follow what has happened since the open, seen the trading range, seen the pushes up, seen the bear breakout, seen the bull attempt, one solitary bull trend candle after the bear breakout, and then go inside and then we start to sell off, you can take that trade comfortably. Then we have a breakout and the bears finally get to a measured move of the opening candle. And because the bulls failed to break out above the candle, the bears want to see if any bulls come in at the measured move of that trend candle, but the bears were strong enough to break out beneath it. Now we have this breakout candle, and the measured move is here. That's why the bears accelerated down to that right up until the end of that particular session. Another example, bear breakout from a 2-push reversal pattern, 3 pushes up, 1, 2, 3. 3 pushes is a wedge. Anytime you have 3 pushes, it's a wedge. Top may not look like a wedge, but it's called a wedge in terms of price action. 1, 2, 3 led to a trading range, a pullback from the wedge top, tight trading range. You'll learn to recognize this as we see more and more often from the weekly videos. Wedge top, tight trading range, bulls. So this wedge top is the first push by the bulls. Failed, second push by the bulls, failed. Then the bears came in, beautiful enough trend candle from that second push. So you can sell that as a breakout from the 2-push reversal pattern. How about bull breakout from a 3-push reversal pattern as an example? Remember, we've just seen a micro wedge top. We've seen a wedge top. Here we see a wedge bottom. 3 pushes down. 1, 2, 3 pushes down. We are in a currency. 3 pushes down from the open of the Tokyo Exchange. Bears tried to go down 3 times and they failed. Decent enough reversal candle by the bulls. You then get a bull breakout from a 3-push pattern. Fantastic opportunity for you to take that trade. And ultimately, we go to the measured move of this breakout here. So that would have been a decent enough trade to take after seeing these 3 pushes, 3-push pattern by the bears, which failed, the 3-push reversal pattern, bull reversal up, acceleration up, fantastic trade to take. Waiting for a measured move, we got to the measured move. How about a bear breakout from a 3-push reversal pattern? Fantastic pattern, Nikkei 225, right at the open. There is the first candle of the trade, first candle of the session, that candle. Because you ultimately broke out beneath it, the measured move of it is here. Market went up once, immediately failed. At that time, I think the bears are strong, will sell off, but they failed. Bulls tried again, immediately failed. Tried a third time, immediately failed. Clean 3-push pattern. If we see a bear breakout, you must sell. You can sell that immediately. It's got tails beneath it. You need a wide stop, or you can wait for a candle without tails. When you're selling a doji, remember, very low probability, but because of the strength of the wedge top, is something that you can take. Stop is still way up here for this trade and also for that trade. Bear breakout below 3-push pattern, higher probability is to wait for that trade. But when you see that, you know there is targets below that measured move, eventually we got to the measured move. This just marks the end, close of the Hang Seng, which I kind of use as the end of the early part of the morning session. So 3-push pattern, bear breakout from a 3-push reversal pattern. We're just looking for 3 attempts by the bulls to go up. They fail 3 times, then we want to sell when we see the market beginning to go down. Another example, bear breakout from a 3-push reversal pattern. This time we have a micro wedge top. There is the first candle. Bulls were strong, they would have accelerated up. They failed. Bears came into place. Bulls tried to break out above the first candle to see if they could get to the measured move of the first candle. They failed 3 times. Once, failed. Second time, failed. Third time, failed. That's a micro wedge top. Same forces that create a large wedge top pattern. 1, 2, 3 are the same forces in play here. It's a micro wedge, a small pattern, 3 tails, 3-push reversal pattern. there is a trend candle that you can take, bear breakout below the 3-push reversal pattern. You take that trade, use a measured move stop. You can put your stop up here, measured move of the first candle. You can put your stop right up there. That is perfectly fine, or a little bit higher. I didn't mark the measured move of the breakout beneath here, but we reached it quite easily. You could have scaled into the trade here quite easily. Beautiful trade to scale in and put your stop just above here. Strong breakout, put your stop above the pullback. And, you know, when you get a reversal, then you can look to take your profits. All right, guys, thank you for watching Trading the Asian Open course. I look forward to your questions as you watch the weekly video reviews of some of the best setups from each of the 4 markets that we're looking at. Hang Seng 50, Nikkei 225, the yen and the Aussie yen. You know, ask questions as we go through, and I hope you will enjoy the weekly videos as they come through. So once again, my name is George. I look forward to catching up with you. Take care and happy trading. Build wealth wisely. Bye-bye.